How to save taxes in Canada, legally that is. The average Canadian family paid about 45% of its income in taxes, more than it spent on essentials such as food and housing. With tax season looming ahead of us, the question that begs in this ever-rising cost environment is how to save taxes in Canada. That's where tax credits come in. In this video, I highlight 8 overlooked tax credits that provide money-saving opportunities along with tips on how to maximize your tax savings over the long run. A tax credit is an amount that gets taken off from your final tax bill. Think of this like store credit at your grocery. Once you've completed your shopping and your grocery bill is being calculated at checkout, the credit gets deducted from your bill, resulting in savings for you. Tax credits work the same. Tax credits can be either refundable or non-refundable. A refundable tax credit can result in an actual return of money to you from the CRA known as a tax refund. A non-refundable tax credit, on the other hand, can reduce your tax bill down to zero, but it can't go much further than that. So if you had a tax bill of $1,000 and non-refundable tax credits of $1,200, it would reduce your tax bill down to zero, but you won't get $200 as money back in the form of a tax refund. So let's start off with medical expenses. A lot of people miss out on the countless not so obvious medical expenses that you can legitimately claim. These range from private health and dental insurance premiums that you pay for through your work, dental expenses including dentures and implants, hospital stays, birthing care, fertility procedures such as IVF, hearing aids, prescription medication, glasses, orthopedic shoes. The list is quite extensive. These expenses vary in terms of which ones you need a prescription or a doctor's note for and which ones you don't. So it's best to check on the CRA website. I will place a link down where you can quickly search these expenses. There is a minimum threshold that is subtracted from your total medical expenses, and any number above this amount will get a non-refundable tax credit at the lowest federal and provincial tax rate, which is 15% plus 5.05% for Ontario, giving you 20.5% back in the form of a tax credit. Medical expenses don't have to follow the Jan 1st to December 31st calendar year. The CRA lets you pick the 12-month period to claim these expenses, so you should choose the window where your total accumulated medical bills are highest to increase the value of your tax credit. It is beneficial to group all your household medical expenses together and have one person claim these, preferably the lower income earner. The lower income earner may have a smaller minimum threshold, so this would result in a larger tax credit. You can claim medical expenses for individuals beyond just your partner and children. It extends to family members such as parents, grandparents, siblings, provided they depend on you for support. Another item that you may be unaware of is the disability tax credit. A lot of people are unaware that they may qualify for the disability tax credit for either themselves or their dependents. There are a whole variety of health issues that you may develop as you age, such as arthritis, limitations to bladder or bowel function. In 2022, the CRA expanded this eligibility to include additional categories of mental functions necessary for everyday life, such as memory, concentration, and attention. You should take the time to check if you qualify for the disability tax credit. You have to apply for the disability tax credit with a medical practitioner's approval. For the 2023 tax year, anyone eligible who is 18 or older can claim $9,428. And if you're 17 and younger, you get an additional $550. Next up, we cover digital news subscription. If you pay for a digital news subscription, such as a subscription to the Globe and Mail, you can claim up to $500 in bills. You need to check if the organization qualifies, and I will link the list so you can search this below. For those of you buying your first home, please remember the first-time home buyers amount. If either you or your partner bought a home for the first time, please remember the $10,000 home buyer's tax credit. You will get a non-refundable tax credit at 15%, so this will give you a nice $1,500 in tax savings. Next up is charitable donations. Charitable donations are a great way to support causes that are important to you. What I didn't realize is how massive the tax savings are from charitable donations. You practically get half the money you donated in the form of a tax credit. It's a win-win for both you and the charity. The way that charitable donations work is that the first $200 gets the lowest marginal tax rate, and then anything above the $200 gets rates shown in this table. If you're in the highest marginal tax rate of 33%, charitable donations are even more beneficial to you as you qualify for higher tax credit rates, represented by this 33% column. Everyone else qualifies for the 29% column. The table combines the federal and provincial tax credit rates for donations over $200 in 2023. So if you live in Ontario and donated $1,200, on the first $200 you will get back $41 in tax credits. Then on the next $1,000 you will get back $464 in the form of a reduction to your tax bill. A massive tax savings. Tips to maximize your tax savings. Donations can be carried forward for up to 5 years, so you may want to hold off and group these together when you have a larger amount. If you have a partner, you can combine your charitable donations and have one person claim these. In both cases, the smaller rate on the first $200 is applied only once, so you get a larger tax credit. Either one of you is in the highest marginal tax rate, then it is most advantageous for this high earner to claim the collective donations, as you would get the higher credit rate, increasing your tax savings. The next one up is the Canada Training Credit. The Canada Training Credit helps working Canadians between 25 and 64 with the cost of fees paid for courses taken. You get 50% of the fees you paid back in the form of a refundable tax credit. The tax credit accumulates at a rate of $250 per year with a lifetime limit of $5,000. Your Canada Training Credit limit is shown on your latest notice of assessment. I want to briefly touch on the tuition tax credit. If you don't have enough income to make full use of your tuition tax credit, you can carry forward unused amounts to future years indefinitely or transfer it to your partner or an eligible family member like your parents. The maximum transfer amount is $5,000 for 2023. On a related point, we cover interest on student loans. Repaying your student loan can be a pain, but the good news is that the interest portion of your student loan is eligible for a tax credit. If you don't have enough income to make full use of your credit, you can carry forward unused amounts for up to 5 years. Unfortunately, only you can claim this interest tax credit and no one else. I highly recommend filing your taxes electronically as the software performs automatic calculations, reducing errors. If you have children, dependents, or you may be retired, the software guides you through the tax credits and tax deductions that may be applicable to your specific circumstance. Were you aware of these tax credits? Let me know in the comments down below. Thank you for watching.